The name of this reading is Market Organization and Structure. This reading is essentially focused on those candidates who have absolutely no exposure to equity markets, which means we would be learning the basic terms and the nomenclature which is used in the markets. There is absolutely nothing which is difficult in this reading. So if you're already someone who has background in the market, some part of the readings are going to be repetitive. But my assumption for this reading is that you have no background whatsoever, and I would be spending time on all the basics. The first learning outcome, main functions of the financial system. So there are three main functions of the financial system: save, borrow, issue equity capital, manage risk and exchange assets. Then determine the return that aggregates savings and allocate capital in the most efficient manner. See if you can answer. Is the answer? Different classification of assets. So I've converted this learning outcome into a flowchart. Financial assets versus real assets. Can you tell me what is financial asset? Buying a stock would be a financial asset. Buying gold ETF would be a financial asset. But buying gold would be a real estate. Buying real estate would be a real asset. Then public versus private. What would be the difference? Public means the ones which are listed and you can buy the stocks on exchanges. Private means non-listed organizations. Debt versus equity. You know the difference. Money market versus capital market. What would be the difference? Money markets are short term. Capital markets are long term. So one sentence you can write down. Heading would be money market. And then one sentence you would write down is securities with original maturity less than 1 year. And then double underline the word original. Okay, now what does it mean? Let us say there is a bond which was issued 19.5 years ago and which had a total maturity of 20 years. What is the remaining maturity? 0.5 years. Is this a money market instrument? No, because the original maturity is not less than 1 year. But if there's a T-bill which is issued with a maturity of 180 days, then of course we will consider this as money market instrument. Are you fine with this? Then spot versus future delivery. What is the difference? So you go to a vegetable market, you want to buy tomatoes, you pay money and say, I want to buy 1 kg of tomatoes, that's spot. But you tell him that take this money and deliver tomatoes to me 3 months from now, then that would be a future delivery. Then traditional versus alternative investments. So at level 1, in fact, entire CFA program, there are 4 asset classes: equity, fixed income, derivative, which we will classify into traditional. And then the 4th subject that you have, alternative investments. So we will have commodities, real estate, all those parts are components of alternative investments. Primary versus secondary market. Can you help me understand what is this? So if this is a company and for the first time company is issuing shares and all of you people buy those shares from the company, then this would be a primary market. Now once you purchase the shares, the same shareholder now, they will meet each other in an electronic format through an exchange. And then the same shares that they purchased, they will sell that to each other. And then this demand and supply will determine the price, which would be a secondary market. Should we go ahead now? Primary market. Money market. It would be a public security. Commodities, because it is a real asset. Okay. Next, learning outcomes. Characteristics and subtypes of types of securities, currency contracts, commodities, real asset that trade in organized markets. So major types of assets, we would divide them into 5 categories: securities, currencies, contracts, commodities, and real assets. Securities we will further divide into 3 categories: fixed income, equity, and pooled investment vehicles. What are these? Yeah, easiest example to think of them is mutual funds. So again, the structure of a mutual fund is, most of you know it, but just to make sure that all of you know, that if there are 10 investors, all of them will connect some money and they will invest this money with this mutual fund company. Then this asset management company in turn will invest this money into different stocks, and then if the valuation of the stock will increase, then valuation of the units of the investor will increase, and therefore these are called as pooled investment vehicles. Are we fine? Now fixed income will have multiple components: bonds, notes, and commercial paper. So all of you know what are bonds. What would be notes? Yes, similar to bonds, but these are medium term maturities. And commercial papers, what are these? So again, this you can write down. This part you can write down. That certificate of deposits are issued by banks and commercial paper are issued by corporates with high credit rating, or simply corporates, and both of these are zero coupon instruments. And zero coupon instruments at times are also referred to as discount securities. Same concept. So what a discount security essentially means is, you buy it at a price of 90 and after 1 year you go and take 100. You do not take any coupon in between. Certificate of deposit issued by banks, commercial paper issued by corporates. Certificate of deposit issued by banks, commercial paper issued by corporates. Both of these are zero coupon, also referred to as discount securities. The question is asked, is it same as debentures? So as far as CFA exams are concerned, if they use the word bonds, they are usually referring to the secured investments, and if they use the word debentures, then we are referring to unsecured investments. Okay, so in India, of course, there's a legal difference between the two, but from a CFA exam perspective, a bond means it is secured. So if the company defaults, you will have a right to go and take some asset. Debenture means unsecured. If company defaults, you will not have a right on a specific asset. You will have a general right after all secured bondholders are paid off. Are we good to go ahead? Then equity will have common stock, preferred stock, and share warrants. Okay, so all of you know what is common stock and preferred stock. What would be share warrants? Yeah, similar to ESOPs, it's similar to a call option. You will have a right to buy shares of a company at a cheaper price. Pooled investment vehicle will have mutual fund, ETF. ETF is exchange traded fund, and then okay. Currencies can be traded currencies can be traded either in the spot market or the forward markets. Contracts, so all types of derivatives, futures, forward, options, and swaps. Okay, so we have a complete subject on this. We will discuss it then. Commodities, so commodity could be either the agricultural products, or it can be industrial metal, precious metal, or it can be energy products. It can be traded either in the spot market, future market, or forward markets. And then real assets. Alright, so answer this question. Is it B? Yes, because equity will not include commercial paper. It will include preferred and warrants.